And hey, Rick.
Hey Megan, how you doing?
Oh, sorry. Lots of beeping over here. I'm transferring data. I'm doing great, Rick. It's Tuesday,
It
and
is.
we're always talking to people about the costs of things, how much a house costs every month. That's a big
Mm-hmm.
deal because people don't usually look at the price tag of a house, but they look at what the payment's going to be every
Mm-hmm.
month. But sometimes that puts some blinders on. And so we wanted to break some things down for our audience today. And that is
Mm-hmm.
three scenarios at an $850,000 purchase price. Okay. Rick's going to walk us through a couple, three scenarios of 5% down, 10% down, and 20% down. So, Rick,
Mm-hmm.
you take it away, and then I'll take over the other part of it.
Yeah, thanks. We get this a lot. People they always want to save. I want to save. They want a lower payment. We get that, but they say, well, I want to save more money. Well, that sounds great on paper, but what does that really mean in reality, right? So let's look at this example of 850. A 5% down payment is a down payment of $42,500 down payment. Okay,
Mhm, mhm,
5% down. But to go to a 10% down payment, that's 90,000, I'm sorry, $85,000 down payment. Okay, that's a
mhm.
big leap.
That's a
Well,
big difference.
it's a really hard to save an extra $42,500 for anybody,
Mhm,
right? That's a
mhm,
huge leap. But the more important thing I think to consider, Megan, is what's the impact to the payment.
mhm,
Okay, so let's look at that. Let's just take a generic, let's say generic, very generic rate of 6.5% just for an example. Okay. If you did 5% down, the mortgage payment is 5,104.
mhm,
But if they had the extra double the down payment, the mortgage payment drops to 4,835. Well, what does that mean? Well, that means that the difference in monthly payment is $269. Now,
mm,
which is harder to come by? An extra 269 per month or an extra $42,500 down payment?
mhm,
So what happens is I think a lot of home buyers don't kind of recognize the difference or the relationship between down payment and monthly payment. Okay.
mhm,
And I'd say that for most buyers, it's much easier to come up with less than $300 a monthly payment to get the house they want now, rather than waiting to save an extra 42 or $45,000 to get the house later.
Yeah, like how long does it take to save an extra $45,000? I
Who
mean,
knows?
and if we look at the appreciation of the market, very
Hmm.
conservatively, it's 5% a year. Super
Hmm.
conservative, not a
Hmm.
dreamer number. And at
Correct.
885, that house you're looking at today for or 850, I'm so
850.
sorry.
Hmm.
The house you're looking at today for 850 is going to be $45,000 more next year. It's going to be nine something. And
895,000 basically the next year. So
and
let's
you
say that
have
you could save that much money in 12 months. Let's say you could hypothetically. Well, that same house theoretically is not 850, it's 895. So how
bingo.
much have you benefited by saving an extra $42,000? Now, if you were to buy the house now, your payment is a bit higher, but look, you've made 45,000 roughly in equity during
Yeah,
that same period of
exactly.
time. Yeah.
Now, people don't want to pay PMI, and we have here in our example just principal and interest at
Mm-hmm.
today's rates,
Mm-hmm.
no,
Mm-hmm.
nothing snazzy. So
Mm-hmm.
what does PMI look like on less than 20% down?
It's not that much. Typically, depending upon the down payment, it's less than $100 a month or right around $100 a month, something like that. It's not huge.
Mhm.
It's fairly
Mhm.
small these days. The P-money companies have all lowered their premiums, thankfully. So
Mhm.
honestly, people get really concerned about PMI, and I get it. Look, no one wants to spend an extra $100 a month more or whatever that sometimes is less on the monthly
Mhm.
payment. But the reality is, if we didn't have the PMI programs, you would have to have a 20% down payment.
Right. Yeah,
So,
it's
so the
kind of pay
PMI
to
has a lot.
play here.
Yeah, there's a lot of value in that. And by the way, people don't know this as well, is that the PMI, Megan, is not necessarily a permanent payment. Okay.
Mhm.
There are two ways to get rid of PMI down the road. One,
Mhm.
if you're in the house for at least 2 years and you get more than 20% equity buildup, you can request to have that PMI removed without
Mhm.
refinancing. Just take it off the house. Okay.
Mhm.
That's always the one potential. Number two, down the road, if the rates go down, you're going to certainly have more equity and the rates have gone down. Then you refinance the house to the lower rate, lower payment, and then that as well can drop the PMI.
Mhm.
So it's
Mhm.
not
Yeah.
forever. Think of the PMI as a vehicle to get you into the home for now.
Right. It's a small price to pay to be in the house, and quite frankly, we have PMI on a house we co-signed for, and I have never thought about it ever again. All I've thought about
Yeah.
is that we have the house, and that's that. You know what I mean?
Yeah, well, I
Um,
guess as we're talking about this, I guess one way you can really think about that, think about it in terms of, driving to work. People take the toll road. Well, you can take the toll road and spend $10 a day, or you can take the 5 or the 91 or the 405 and spend an extra hour a day on the road. Well, people choose to spend the $10 a day to save the hour a day on the road. Well, the
mhm.
PMI is kind of the same thing, right? Spend the money now to save the money down the road.
Mhm.
It's just a
Mhm.
better trade-off.
Yeah, because the difference in the payment, just principal and interest
Hmm.
on a standard situation for 850, with 5% down versus 20% down, is
Hmm.
$774 a month, and difference in
Correct.
payment.
Huge.
But if you're, in the house and you're gaining equity at 5%, that's the
Hmm.
44,250 a year divided by 12, you're making in equity $3,687 a month in
And
equity.
equity. Hmm.
Plus, you've got a tax write-off,
Hmm.
you've got a home that you own.
Hmm.
And so, you know, payments, it could be pretty painful, but you have to step back
Yeah.
and look at the whole picture. I sometimes we look at a solution that's right in front of
Hmm.
our face, and
Hmm.
we don't lift up any rocks to kind of see if there's any other
Right.
factors to count in.
Yeah, well, for sure. If you look at that number, the difference, say, for example, between 5% down and 20% down, and look, I wish we could all do a 20% down purchase. That'd be really, really cool.
Yeah.
But
Right.
look, in this example, the difference in down payment between 5% down and 20% down is $127,500 more down payment. Well, the reality is, if someone wants to try to save the extra 127,500, they may be waiting a long time to do that.
Right. Yeah. That would take, yeah, that's a very long time of saving up that money. It's hard to keep up with the market.
Right. Yeah, no doubt.
All right, Rick. Well, this has been a valuable lesson today. I hope having these visuals has helped people to kind of help break down these numbers and these
Hmm.
different scenarios. And if you have a scenario in your head that you want Rick to take a look at for you and spell things out, I'm sure he would be
Yeah,
happy to do so.
happy to do that. Absolutely.
Yeah, so just message us. All right,
Yeah,
Rick,
let
I
us know.
appreciate you. This
Thanks,
was
Megan.
short
Appreciate
and
you.
sweet, but it was prepared and to the point. So hopefully everybody could see the value in that. And again, message us if you have any topic that you want covered.
Awesome. Hey, thanks, Megan.
Thanks, Rick. All
Hey, see
right.
you later.